Alrighty, folks, I'm going to go over the analyzed categorizing credit worksheet that I had you do. This was the first assignment in the credit unit. The reason I start off with this one is because it's really important to know that there are different types of credit. And when we think of credit, you've probably heard of a credit card or a debit card. Just to clarify the difference between those two, when you use a debit card, that money comes directly out of your checking account. Whereas if you use a credit card, you have time to pay off um, whatever money you spent. So basically, why people say, you should be very careful with your credit card is because you don't want to spend more money than you have, because then you'll get charged interest, and then, you just fall into this hole, like you dig deeper and deeper. So basically, credit is just like, think of it as a loan in some sort of fashion. Things like car loans or getting a mortgage on your house or, your credit card, they're all different ways of basically borrowing money that you may not have immediately but plan to pay off. Okay, so there's three key differences between types of credits. The first one is installment loans versus revolving credit. And so an installment is basically where you have uh, a set amount of money that you're going to pay off every month, usually for a specific amount of time. So, for example, you may, let's say there's like $1,000 computer that you want to buy, but you can pay it off in monthly installments of, $100 a month, right? So for a year. So at the end of the loan, it's $1,200, right? So you spent more money than you would have if you just bought it outright, but at the same time, uh, if you don't have $1,000 right away, then that might be the better option for you. So that's an installment loan. Similarly, a revolving credit uh, is an open line of credit. So basically, this is your credit cards, right? So as long as you're under the credit limit, in case you guys didn't know what a credit limit is, so when you get a credit card, which I'm sure you all will soon enough, you get a limit on that. It's not like you can just spend millions of dollars on a credit card, right? So the bank will give you a limit. So usually, if you're young, you're unemployed, you're a student, they may give you a couple $100, maybe $1,000 as a credit limit. So you're not allowed to spend more than that amount of money. I would highly recommend that you don't even get close to reaching your credit limit because it affects your credit score, but we'll talk about that after. So anyways, revolving credit is, let's say you have a credit card, and then depending on what you buy and how much money you spend and how much money you pay off, your credit limit, your line of credit is going to change, right? So how much you're going to have to pay is going to change every month. That's basically the difference between installments and then revolving credit. So installment is like it's set. Every month you know exactly how much. Revolving credit really depends on how much you're purchasing and the size of your debt. All right, the second thing is secured versus unsecured debt. So secured is basically your debt's tied to a specific asset that's used as collateral. So the word collateral really means in exchange. I think that's the best way to think about it here, at least. So let's say you go to the bank and you say, like, hey, I have this idea. I want to start this business, and I think I have something, a really good idea here that like I have this new product, and I think it's going to be really big. Um, and so the bank will say, okay, I mean, that's all cool and stuff, but so what are you going to offer as collateral? Because the bank's not just going to give you, $100,000. Right, the bank may say, I want to own a piece of the company, or I want you to put up your house as collateral or something, because the bank doesn't want to take on the risk, right? Why would they just give someone $100,000 if that person could just run off with it or spend it, irresponsibly? So they want something in exchange just in case that person doesn't pay off their debt or doesn't make the payments, right? So in unsecured debt, the debt's not tied to a specific asset, so there's no collateral. Um, so if you don't pay it off, there's nothing that they could necessarily take away from you. And then the last thing is variable versus fixed rate. So variable rate is when the interest rate can change based on prime rate or index rate. I'm not going to talk about these two things. They're really not that important for you to know at the moment. The important thing about variable is, I mean, I'm sure in science and whatnot that you guys know that variable just means change, right? There's a varying amount. The interest rate will change over time. depending on these two different things. A fixed rate is it's going to be the same exact interest rate over a period of time. Okay, so these are the six different types of credit that we have. There's some articles here that really gave you the answers to all of these basically. So you can check there for further explanation if you feel like I didn't touch on something too well. But basically the next thing was to fill out this chart, right? So you have the three different types of credit, or three different factors, and then various different types of credit. So the first one is auto loan. So auto loan, obviously, when you're trying to go buy a car, you might not have the money to just buy the car outright. So you might have to, get a loan. And so usually the way car auto loans work is they're installment loans. So that means that you are going to pay a set amount of money every month for that car. It is usually secured. Why is it secured? Well, if you don't pay off the money, guess what? They're going to take the car back, right? So the collateral in this case is the actual car. So same thing with a house. If you don't, so if you look over here, mortgage just meaning house loan. If you don't, pay it off, they're going to take the house away from you. That's basically the way it works. You have to make these payments in a secured loan. And then variable versus fixed, it can really be either. CBE could be either. I would recommend, if you are going to buy a house or you're going to get, maybe a personal loan or a mortgage, I would recommend right now that you do a fixed loan, fixed rate loan. And the reason I would recommend that is because currently, if you guys didn't know, if you're not following the markets, uh, right now, interest rates are really, really low. And so I would highly recommend that you do a fixed rate loan. That way you get a pretty good deal now versus what I think interest rates will eventually go back up. So that's really what fixed versus variable means. Fixed just meaning you can either take the interest rate right as it is right now, or you can let it, you can pay based off of what it is every year kind of thing. All right. So that's why it could be either. I would recommend fixed for the most part. All right. Credit card. So credit card, like we mentioned above, is revolving credit, meaning, depending on how much you spend, depending on how much you pay off and how much debt you have, that's going to be how your payments are. It is unsecured, right? So if you spend too much money on a credit card, they can't necessarily take something away from you. I mean, it's going to really like kill your credit score. You should never ever do that. But we'll talk more about credit scores later on. And credit cards are usually variable. It changes depending on how market conditions are, and if you guys remember the APR, those kinds of things change. Next, we have mortgage. Mortgage just means if you try to buy a house, you have to usually get a mortgage. It's really just a way of saying a house loan kind of thing. And so that is an installment usually. It is secured, right? If you don't pay it off, they're going to take away the house. And it could be either in terms of variable or fixed. Once again, I would highly recommend you do a fixed rate loan. Payday loan, I'm not going to talk about this. It's not too important. Personal loan. So this is a personal loan from the bank. Let's say you want to get something, or you just need a loan for something. Maybe you want to get an extension on your house, or renovate something, or you need to fix up your car, or whatever it may be. That's usually an installment. So you're going to pay the same number usually every month. That is unsecured. So if you have a good understanding with your bank, a good credit score with your bank, then they'll check all that kind of stuff. See if you're reliable, and because it's an unsecured debt, there's usually no collateral here. You guys ever heard of a home equity loan? That means you take out a loan depending on your home equity. So the collateral there is your house. Once again, this could be either in terms of variable or fixed. Small business loan from the bank, similar to the example I gave above. It could be either in terms of installment or revolving, depending on how the business does. Secured, usually the bank will take a piece of the business, and if you're not paying off your debts, your business is going to basically fail. And once again, it could be either in terms of variable or fixed. Once again, for all of these that could be either, I would recommend that if you're actually trying to get a loan, you get a fixed loan for these at the moment because interest rates are low. All right, student loan. This is federal student loans. If you're going to college, you need to get some student loans. Those are usually installments as well. Those are unsecured, right? It's not like they can take away your degree or something. You're obviously going to have to take out the loans until you graduate and then start making money with a job. And so these are unsecured, and these are usually fixed rate. There are some variable rates if you do something that aren't federal loans, but once again, I would try to recommend fixed if you can. Obviously you want to read the fine print, but for the most part, fixed is the better choice. Okay, so some of these questions. Why do people sometimes use credit to pay for items instead of just using cash, right? Like, if you have money in your checking account, why would you use a credit card? Um, Sometimes you might not have the money, right? Let's say you need to make a big purchase, you need to get a piece of furniture, or your laundry broke, or whatever, you get a new washing machine, or whatever it may be. And your paycheck comes on Friday at the end of the month, and you don't have any money right now. So you might just, put on a credit card, and then once your paycheck comes in, you can just pay it off then, right? You want the safety or rewards that come along with credit cards. So, credit cards usually have like 1%, 2% cash back, that kind of thing. The safety is sometimes, there's something called fraud, your credit card fraud, where someone, if someone gets a hold of your debit card and they clean it out, like you can't do anything about it. Like you really got screwed over. So with a credit card, the company will dispute that. So let's say, I accidentally lose my wallet, okay, and someone, takes my debit card and uses it. I can't really do anything about it. Like that money's basically, they're just taking that money straight out of my bank account, checking account, it's gone. But with a credit card, because you haven't actually paid it off yet, I can call my credit card company and say, hey, my card got stolen. Please, deactivate it. If there's any, if they, let's say they stole my card and they went out and bought something, or they went to a gas station and filled up gas using my credit card, I can dispute that, and the credit card company, like Visa, MasterCard, all those companies will usually take care of that for you. So you don't, it's a little bit more safety. You might not want to carry a bunch of cash in your wallet, and you might want to build a credit history, which is really important when you're young, because when you're trying to go and buy a car or a house or get a loan, your credit history really matters. If you have really bad credit, then they're going to give you a really high interest loan. If you have good credit, they'll give you a low interest loan. If you don't have any credit history, then they're going to be like, I don't really know. So you might want to spend a little bit of money on a credit card just to build up that credit score. We'll talk about that more after. It's also financially more advantageous to save and pay down low interest loans. All right, so when applying for credit, is it preferable to receive a low interest rate or a high interest rate? Low, right? Why would you want to pay more money? If you don't pay your balance in full, you're charged an interest rate on your balance. Lower rate means you owe less. So, if you owe $100 and your interest rate's 5%, then, you owe extra $5. If it's 10%, you owe extra $10, right? So the lower the interest rate, the better. Whenever you're borrowing money, you always want the lowest interest rate. When you're lending money, right, when you're putting money in the stock market or in bonds or something like that, you want a high interest rate, right? Because you want to make more money. Okay. Number 6, sometimes lenders allow or require a down payment before they extend you the loan. What would be the advantage to the lender? What would be the advantage to the borrower? So to the lender, they already have some money, right? In case the borrower defaults, or they default just meaning they can't pay it back. They already have some money on them, so you might have to pay a down payment on a house or a car. Um, and so it illustrates the borrower is initially at least taking the loan in good faith, right? That they plan on paying the money back. To the borrower, no interest is paid on the down payment. So, the higher the down payment is, usually the lower your total cost of the loan will be. So you always want to try to pay things off as soon as possible, because that way you don't have to pay as much interest on them. And then I looked through Google Classroom for some of the questions you guys may have. A lot of people asked, why are there so many different types of credit? I mean, there's no really easy answer to that. It's just like there's so many different types of credit because of the types of different things you can get credit. Uh, Different types of things you can get with credit, right? A car is going to be different than a credit card, than a student loan, than a mortgage, than a personal loan, and that's why there's just so many. I know it's complicated, but that's just the way the real world works. Alrighty, folks, I hope this helped. If you have any other questions or comments, please feel free to email me or drop a comment down below in the Google Classroom, and I will answer them to the best of my ability. Thank you very much.